Eurasia offers substantial opportunities for mining project development, investment and trade finance. However, navigating the funding landscape in this region requires a thorough understanding of the challenges and opportunities involved. The growing collaboration with London and other global capital and investment markets is vital for securing supply chains of critical raw materials and supporting the sustainable development of the mining industry in the region. Recent developments have highlighted the potential for growth in the region. The UK's approval of export finance to secure critical minerals for major UK industries has opened up new opportunities for companies such as Uzbekistan's Al-Malik Mining and Metallurgical Combine, which was one of the first projects to benefit from this new scheme. Earlier in October, Navoy Mining and Metallurgical Company also successfully raised $1 billion through a dual tranche notes offering at the London Stock Exchange. The European Bank for Reconstruction and Development has also launched the Junior Mining Programme with €150 million dedicated to early-stage mining companies, focusing on critical raw materials for green and digital transitions. This initiative aims to support the development of the mining industry in Central Asia and promote sustainable growth. Looking ahead to 2025, Navoy Mining and Metallurgical Company plans to list on the London Stock Exchange, positioning itself as one of the largest publicly traded gold producers globally. Additionally, smaller companies involved in mining projects in Kazakhstan, such as Scythian Mining Group, are also preparing to raise funds through London's capital markets. A hands-on discussion will delve into specific case studies of successful projects, explore funding models like public-private partnerships, and examine strategies for mitigating potential risks.
Great, thank you very much. Excellent. Well, welcome all to this session 2, Bridging the Gap Between Miners and Financiers. We're very privileged to have a distinguished panel here representing a range of financiers and also from the corporate world. So we have the IFC, the EBRD, UK Export Finance, London Stock Exchange and ACG Metals, all of whom are active in the region. So I think this will be quite a useful session to give us an insight from both perspectives and how to get a project in the region financed. So I think just to start and set the scene, I'll ask each of the panelists to sort of introduce themselves and say a little bit about their interest in the region, and then we're going to go on to case studies from each of them. So if we start actually with you, Iona, at the end, please.
Hi, everyone. My name is Iona Nechaeva. I'm head of Europe Primary Markets of the London Stock Exchange. A huge amount of interest in the region, of course. I've been doing IPOs and working on transactions in Eurasia for the past 15 years or so. I have been, very honored to see some of the bigger transactions from the companies come to the market, including the deal that just been mentioned from Navoy. But I'll pause here and hand over.
Thank you. Artem Volnyets, I'm Chairman and CEO of ACG Metals. We started our life as a SPAC listed on LSE a couple of years ago, completed our first transaction in Turkey in September. So now the difficult SPAC childhood is behind us. And we look forward to doing more transactions in the copper space to build a large copper company listed in London.
Good morning, everyone. I'm Namrata Thapar, and I'm the global head for the metals and mining at IFC. The region is of great interest. We are a leading DFI, especially in the metals and mining space, and in the last 10 years have done about $8 billion of our own, but also mobilization of capital in the metals and mining industry. And one of them was in Mongolia with our partners EBRD, and many of you probably in the room as well, where we raised $4.4 billion for the Oyu Tolgoi copper gold mine in Mongolia.
Good morning, Chris Allen, Senior Business Origination Officer from UK Export Finance. Our ultimate goal is to promote UK exporters and British business abroad. I work in the international client coverage team, and we are a governmental entity. We're the UK's export credit agency. It is a bit of an untapped market for us so far in Central Asia, and we're looking to very much establish ourselves and look for future projects.
Good morning. My name is Natalia Lacursana, and I'm head of natural resources, which also includes mining and mining services at the European Bank for Reconstruction and Development, EBRD. I'm quite excited to discuss a sector that is critical for the world's energy transition, digitalization, infrastructure development, and overall economy growth. So EBRD, like IFC, is an international financial institution. We've been financing and investing into mining projects for the last 30 years. So our support to the sector is quite unwavering. We've invested some 3 billion in over 70 projects across 14 commodities in 15 countries, and many of those commodities are now considered to be critical or strategic, but also, of course, into those that are essential for our daily lives and economic development, including iron ore, chromium, zinc, and as well as precious metals. Most of our financing is to private sector, and while we can do both debt and equity on a volume basis, the majority has been into debt products. Our support of the mining sector has three main components. Of course, it's first of all providing access to a full range of financial instruments, but we also provide technical assistance and capacity building to mining companies in areas that are strategic to them, from gender and inclusion to decarbonization and resource efficiency. We also, the third pillar of our work is that we work with the governments to modernize the mining sector by improving the regulation and business environment to make those sectors more attractive for investors and to implement best practices in the sector. Thank you.
Fantastic, thank you. And I think then gives you an idea as to why you might want to speak to any one of them, any one of our panelists after this session. So I think to start with, what we'd like to do is look at some of the case studies, because if we're looking at bridging the sort of funding gap, I think the most useful thing is to understand how people have done that in the past, what challenges they faced during that, and how they overcame those challenges. And Artem, I'd like to perhaps start with you, please, because you've been very active in the region and can give a great insight from the sort of corporate side in terms of attracting that investment and what you have to do to be able to attract it.
I'm sorry, I'll be very plain and simple. In that simplicity, the good deal always find the funding. And what I mean by good deal, it's a transaction that creates value for both parties. It is not a single issue negotiation where I want to pay less and the selling party want to get more. And I give you two very specific examples. Last year, we worked on $1 billion deal in Brazil. I was buying nickel and copper asset. I put together $1 billion from very big names: Stellantis, Volkswagen, Glencore, La Mancha, 3 banks, US royalty company. And as I was busy doing that, the nickel price declined by 50%. So we went to the seller and said, well, maybe we should do something about it. And the seller wasn't prepared to do something because he was very much focused on a single issue, which is how much cash I will get upfront. So what I felt that we dodged a large nickel bullet, and we went to do a transaction in Turkey with our great partner, Charlie Holdings, who were much more flexible in terms of the approach, because their thinking and our thinking is that the value is not created in dividing the pie. The value is created in growing the pie. So then you can think about the elements which would enable you to do the deal at attractive multiples. The transaction in Turkey was done at 2 times EBITDA, 0.3 price to NAV, which is unheard of for a producing asset. Why? Because we have introduced elements of deferred consideration, links to the copper price, a large equity component, whereby we are aligning our interest with our large and important shareholder. And in looking at other deals that we have in the pipeline, in my view, only those will work where we will have similar type of structures, where it's not all about cash up front, but it's about creating the mechanisms for the joint value creation going forward.
Okay, thank you. So then in terms of the the type of investment that you had for that? It was predominantly using your equity as a listed company then, was it?
No, for us, the funding comes in all different shapes and forms. It's typically prepays from the large off-takers. Both Glencore and Traxys are our shareholders, so the off-takers can also participate in equity. It is a debt funding, whether it's a private credit or banks, it depends how quickly you need to do a thing. We are seriously considering going into the bond market as another form of debt funding. And yes, equity is there, but what we are doing in terms of the building large copper company via a series of roll-up acquisitions, you want to exercise and use as much debt as possible because it's a classical LBO. You raise a lot of debt, you repay it relatively quickly, and the equity returns are enhanced. And thus, we only looking to buy producing assets, not developments. You can raise cash for an acquisition of producing assets. So the funding comes from all specters of possible funding, but money is a commodity. It is finding and doing a good deal that is important.
Yeah, no, I think that's a very useful thing to bear in mind with all of this. But now I think we'll open it up to the rest of the panel who come at it from different perspectives. And Natalia, perhaps you could start with an example of how EBRD has supported a mining company in the region.
Yes, thank you. And I'm glad to follow up on what Artem was talking about, a good deal or good client in our case, because we're also a client-focused institution. And I mean, for us in Eurasia, the majority of financing have been provided to companies in Mongolia, Kazakhstan, and Turkey. And when I was thinking which one to select, I've settled on a dear client from Turkey because we financed them in 2017 and 2018, so we can actually see the results and reflect on how they've been doing. And I'm referring to a company called Tumat, which is owned by Nurol Group. It's a large diversified Turkish group. So in 2017 and 2018, we provided approximately $90 million through a large project finance facility, which we were joined by two local banks, Ziraat Bank and Akbank. And the company had the ambition to develop two gold mining assets in Western Turkey, Lapseki and Ervindi mines. So 7 years down the road, they are the second largest gold producer in Turkey, providing approximately a quarter of what the company is producing. But the challenge was that they were a newcomer to the mining industry. It was a new sector for them. So, our requirement was, and they totally understand that, and that's how they wanted to develop the asset, to put together a very strong project team that I had to bring from outside, as well as, capable people from within the Nurol group, but also use skillful local mining contractors. So we, as the financier, of course, given that it was a greenfield financing, required support with completion from their sponsor. The permitting procedures in Turkey are not that easy, but the company was able to skillfully navigate it, given their experience in the construction sector and other sectors that they've been involved. But the key that distinguishes Tumat, and that's where EBRD put an emphasis, and we work with them, is ensuring that the relationship with local communities are solid, and that the company develops a comprehensive economic inclusion program, which they did. It was very important because this part of Turkey has a very high unemployment, youth unemployment. At the time, about 18% of the younger generation was unemployed versus some 7% or 8% in Turkey. So Tumat employed best technologies. They used dry stacking of waste, which was quite unprecedented in Turkey at the time, and maybe still is. They also focused on effective management of their carbon footprint, tracing and understanding both scope 1, 2, and also 3 emissions. And now they are on the path to also build in renewable power generation that is captive to their mines and that supplies their mines with renewable energy. They've built a number of technical education establishments where they've also trained and gave also employment opportunities for population in the area which is adjacent to the mine. So they've employed about 2,000 people, and 70% comes from the local communities. So they built up a technical college, a secondary school, and also a 1-year operatorship training program. So they build a whole chain of education and training for their own, employment, but also for those other mining companies that exist in the region. But also, what also differentiates them is the engagement with the local communities on the social and economic development. What totally fascinates me that they've set up a strawberry, essentially a strawberry farming collective, which revitalized strawberry growth in this area and which kind of employs local population. So they were able to, grow 150 tons of strawberry every year. And that was giving employment to local households, to men and women, because women inclusion in that part of Turkey has not been great, and Tomat worked a lot to support it. And they also created a local collective that was essentially taking care of essential activities in the region, from running the local petrol station, buses, producing garments for the local hospitals and the mine, and so on. So despite just direct employment, what they've done, they created this mini economy around the mine, which hopefully will survive the mine. The mine has a very long life, but the idea is to basically leave something after the mining is gone in many years to come, for the local population to be there. So for us, the key challenge and the lesson learned was to really make sure that we as development institution engage with our clients to make sure that they build sustainable projects.
Yeah. And I think sort of just 2 follow-on questions for you is, I mean, going back to Artem's point around, the key is a good deal will always get financed, but how important are those wider sort of developmental objectives to your investment? As in, would you have invested without those, or are those a sort of a fundamental part of your investment?
Thank you. No, these are the fundamental part of our investment, and what we look around, it's not only the IFIs and DFIs that require it, it's all the stakeholders are after absolutely the same thing. It's absolutely crucial for our customers, for our investee companies to have a real buy-in of those issues. And not only for the companies that are already in operation, but even those whom we support at a very early stage, that are pre-FID, that they have this mindset that they want to develop, they want to engage with the local communities, they want to develop local communities, they want to have what we call the social license.
Yeah. Okay, thank you. Sorry, the other follow-up question on that, before I let you off the hook, is just around, you mentioned that there were 2 local banks who were also part of the investing group. How important is it for you to see that sort of local support? Is that something that you're doing specifically to try and mitigate some of perhaps the political risks, or is it just a sort of function of how much money was needed to be raised?
Well, because we are specialized region-focused institutions, we by definition accept political risks that come with investment in those areas. So it was more a credit decision, because we first of all wanted to make sure that there is a complete a funding solution, that there is no funding gap.
Yeah.
So because we have also single legal limits and so on, but also for us it was validation of the structure and the terms. With the local banks also understand and know certain nuances that we, as the more of international foreign lender, not grasp all the time. So having local banks participating in our financing helps us also to mobilize capital locally, but also give us a confirmation that what we're doing and the terms of how we're doing it really makes sense.
Excellent, thank you. And perhaps, Namrata, I'll come to you, hopefully with a case study that's not Turkey-based, in that this is not just a Turkey day, but over to you perhaps for an example of one of your investments in the region.
Thanks, Alexander. I'll use thanks for leaving Oyu Tolgoi to me, Natalia. So first of all, investment, the way we see it, it's a journey. It's a journey and with partners and different stakeholders. For IFC, we have a triple bottom line, so which is profitability, development impact, and sustainability. And in every project, we have to look at that. Going back to Oyu Tolgoi, we started working on this project with, again, we are private sector, so client-based, with Rio Tinto in the early 2000s. At that time, it was Turquoise Hill. And then as we are also part of the World Bank Group, we were able to work under the umbrella of the World Bank that was also partnering with the government. When we invested, one of the key roles that we played alongside EBRD was being the mandated lead arranger to raise the $4.4 billion. At that time, one of the largest, I believe still today, but one of the largest project finance in Mongolia for the first time. And some of us here in the room were there, and I was there in a different role, and it wasn't easy. It took years of preparation, and the preparation was not just in terms of the financing structure, but also in what we call the impact and the sustainability. So we worked with the private sponsors and the government on environmental and social considerations. For us, working in any project, again, has to be in line with IFC's performance standards, which are considered best practice and which are similar to the Equator Principles. So that aligning that, getting early studies done, working on stakeholder engagement, working with different herders, because it was in nomads and herders were the main stakeholders. So that was one part. The second part was impact, what it would mean for the country. It would be a massive GDP generator when the project would be completed, and especially the underground mine. So that was the other aspect we looked at. And we want to make sure that it's fair to both parties. So a balance of trade between the locals, the public and the private. So we do a whole analysis around that and want to make sure that the benefits are, go to the government and the people of Mongolia. And then on the financing structure, maybe I'll spend a little bit more time. Raising that kind of money wasn't easy, though there were many interested parties. But the structure needed to be put in place for a 50+ year mine down the road, but the ramp up was about 10 years to actually getting the underground done. So you had to manage the cash flow with the debt provisions, and commercial tranche wasn't easy to put in place. What we did is IFC has this B loan syndication program, and so does EBRD, where commercial tranche can come in under our umbrella, which means IFC becomes the lender of record. And that allows the private commercial tranche to take on political risk, though under our umbrella, because IFC can take that risk. Even then, the commercial tranche was not ready to take the political risk. And we brought in MIGA, which is the multilateral investment guarantee arm of the World Bank Group, that came in and then ensured the tranche, that portion of the commercial tranche, which was not insured under our umbrella. So It took a number of years. There were also, as you may recall, shareholder issues between the two shareholders, primarily Rio Tinto Turquoise Hill and the government of Mongolia. In this situation as well, EBRD and IFC, being the largest multilateral development agency, played a critical role in ensuring a honest broker role between the two parties, ensuring that they were able to come to the table to find solutions. So I'll stop. I mean, you may have more questions, but altogether, looking at structuring the finance, the development impact for the country, what it means, so added sustainability structures around local economic development, procurement, so putting those plans in place, and then environmental and social compliance, including biodiversity and water, because these were two big issues that took years and years of work. And just to stop, we're still in the project, and it got rescheduled or restructured a few years ago. And pretty much as a lender, and me myself, for example, spend a lot of time in monitoring and supervising these assets, because we want to make sure it's done right and to the best standards.
Excellent, thank you. And just one follow-up question from me in terms of that sort of political risk and managing that between the IFC being the sort of lender of record and then needing the mega guarantee. Does the IFC sort of do a layer of the sort of political risk then effectively or guarantee? And is it sort of like 80% or something, and then it was the remainder that needed topping up?
So IFC takes on political risk. So
Yeah.
we don't need the guarantee. It's the commercial tranche. Yeah.
Yes.
So they come through the MIGA, which is the multilateral investment, insurance guarantee agency that comes in, and it depends on the sweet and sour piece what the commercial tranche want to take. In this case, pretty much, I would say it was 60-40, if I remember correctly.
Great, thank you. So then perhaps moving on to staying with sort of a predominantly sort of debt side of it. Chris, I'd like to sort of move on to you, please. And then if you could perhaps give an example of a project in the region that UK Export Finance has been involved in.
Absolutely, thank you. Well, actually got announced on the video, so it's the Almalik mining case study that we've got. It's very topical, but perhaps just to start, before going into that case study in particular, just to explain how actually UK Export Finance works in terms of our structure to financing, because it is, we would like to stress, it is slightly different perhaps to, development banks, etc. We're not concessional finance. So we provide a source of commercial debt financing, and it can be under 3 different tranches of insurance finance support, biofinance support, or sorry, it's failed me the third one now, but I will come back to that. But we provide the support, and our typical one is actually on the biofinance side, and this will typically be, we provide a guarantee to the loan that the bank is making to foreign buyer or borrower of a project. So how this works is that we provide 85% of the loan guarantee, so it de-risks it for the commercial bank, who then normally is able to provide better commercial terms for the actual foreign buyer or borrower. So de-risking it for the bank, which makes them involved in a project that perhaps they might not necessarily have done themselves, better commercial terms, and a longer tenor period, repayment period for the actual foreign buyer or borrower. And from our side, we've got two elements. We ask for a premium on the guarantee that we make, as we operate at no net cost to the taxpayer. And because since we do provide 85% of loan guarantees, if God forbid projects do default, we do actually need to pay 100% of that 85%. So we need to cover ourselves there. But then ultimately, the most important point to note is that we provide this loan guarantee on the caveat that the projects are using 20% UK content. And again, this can come under 3 different possibilities. It can come under services. So we talk about consultancy work, design work, legal, architectural design, etc., things like that. Manufactured goods. So this could be anything with an origin of UK certificate. And then we've got intangibles, so IPs, licenses, etc. So buy credit facilities, the very typical and usual product that we use, and this is the case. This was the case for Almalic Mining. So here was the Almalic Mining metallurgical establishment in Uzbekistan. We provided 12.6 million euros worth of support. So we do work across all different ranges of sizes. It can be £1 million worth of projects, or it can be multi-million pound of loan guarantees we can provide. This was done with Weir Group, which is a Scottish based company, and they provide specialised in high-tech mining equipment. And so they operate in about 60 different countries, about 11,000 employees, so a very well-established and respected UK business. So we're working with them in tandem to be able to provide, I think it's about 23 specialist high-tech equipment for the project. And Uzbekistan, it was for one of the largest copper producing facilities in the region. So it was our first project in Uzbekistan, and we consider this one to hopefully be a bit of a flag bearer. I guess to note to some of your issues about the challenges faced when financing for us as UKEF is WAD development banks or concessional financing, because we have that premium. We do have a cost to us. So there's that element to us in a region where perhaps that's more concessional financing has been more of a focus than perhaps us. And then I guess in tandem with that, it's the education piece around us. I think certainly in this region, we're less well known. So there's certainly an education piece that we need to, go out, explain what we can do, what we can provide, what services we can offer, who we are, how it works in terms of support and financing. And hopefully this first project, the Almalic Mining case study, as I said, will be a bit of a flag bearer and put us in good stead for future projects in the region.
Thank you. Iona, I'd like to sort of turn to you now. Perhaps you can say a couple of words around how the London Stock Exchange has supported companies from the region in raising finance.
Thanks, Alexander. So London Stock Exchange operates the public markets on both on equity and debt side, and the barriers to entry could be a little bit higher for companies that have to make this leap from being a private company to all this transparency, ongoing obligations over a publicly listed business. And I'm very happy to say that in terms of Eurasia, specifically Central Asia, we've seen a number of companies make this leap very successfully. So my case study today will be Uzbekistan. So Uzbek corporates and the sovereign this year alone have raised over 4.2 billion USD equivalent via several currencies, including USD, Euro, and the Uzbek sun. And I think it's quite important that the sovereign as well, despite the market volatility, also placed their very first green bonds on the stock exchange. But I think the transaction that's really attracted a lot of attention was the Navoiy, the largest gold producer in Uzbekistan, the top 5 global producer of gold. And I think their deal was successful in a number of ways. First of all, they raised a large amount of money, so it's $1 billion USD divided by 2 tranches. Secondly, the yield was also very competitive. It was just, I think, 3 percentage points above the sovereign benchmark for Uzbekistan. But I think also importantly, it was 4 times oversubscribed. So the level of demand was definitely there. I mean, we're seeing in the markets overall, globally, we're seeing huge amount of volatility. We're seeing that investors have been withdrawing from their sort of higher risk assets into the sort of safer havens. And debt markets actually have benefited from that because obviously, it's a safer asset and the yields are attractive at the moment. But I think for a company from Uzbekistan, a country that is relatively less known, to achieve that is for me is highly unprecedented. It's a frontier market, it's not even an emerging market. So what I think in terms of what we've been talking about, what are some of the things that investors are expecting to ensure that the transaction is accepted, that they are comfortable to invest. And I think when it comes to the public market, it's a slightly different set of expectations. So first of all, I think is governance. Governance is hugely important. So the structure, who are the people who are sitting on the executive and management and the advisory boards. What is the supervision, risk management process? Very important. You need to have people who have relevant experience, not just in the mining sector in this case, but also with the public market. Similar to Artem, the ACG Metals, hugely experienced, executive with an experience with a publicly listed company. Very similar in Navoie, we're seeing, they have Eugene Antonov. I hope he doesn't mind me mentioning his name, who is the deputy CEO in charge of transformation. He also has extensive experience on public company executive and management boards. So I think that's important. Secondly is, of course, sustainability. And again, we have moved on. I mean, maybe when we started this conversation, when everyone started talking about ESG 4 or 5 years ago, I think people didn't fully appreciate that it's not just box ticking. And now we are definitely in the realm when everyone actually fully understands, the difference between greenwashing and so-called box ticking and actually doing things that are right. So it's about, as some of the other panelists said, impact on the community, impact on the society. But it's also actually about how you're doing business across the whole value chain that is sustainable, even if the business in itself is an extractive business. So, and I think in Navoie's case, they had a sustainability policy, and that is also a requirement on the London Stock Exchange. So, if a company is listed as an equity business, for example, there is a full expectations to comply with the TCFD, the Task Force for Climate-Related Financial Disclosure. For debt, again, you're putting together prospectus and all the risk factors and all of your sustainability policies are in there. So investors actually can read through that before they invest. I think that's quite important. And I would probably mention one last thing is that debt capital markets are considered as considered a stepping stone towards the equity capital markets. So a lot of the companies that are Eurobond listed Eurobond issuers on the public market actually do that as a transitional step towards doing an IPO. And sort of they are familiarizing themselves with the practices and the expectations and the obligations, and also they are making sure that investors actually know them and are comfortable, and they're creating that track record. So Navoie, have said publicly that an international IPO is in their plans, and on the stock exchange is the venue of choice. Also, although nothing is guaranteed, in this day and age. So this is sort of the case study, but I'm very happy to talk about broader markets later on.
Yeah, that's great. Thank you. And I think we've heard sort of around a number of the sort of larger projects, but I think larger sort of pools of capital and funding. But I think, Chris, the sort of UKEF has a sort of another product, does it not, for sort of strategic minerals?
We do, and it's brand new, so forgive me for the notes I need on this. It's probably about a week old, hot off the press, but we've got a critical minerals support product now. And this is largely in line with a lot of the policy objectives coming from government, how to ensure that the UK is, importing and having a sufficient amount of critical minerals within the country for UK businesses to be able to manufacture, then also export. So the supply finance provides a guarantee to banks making loans to either an overseas project company producing minerals, so this could be mining, extraction, processing, or secondly, support for an overseas supplier of critical mineral dependent goods that are coming to the UK. So the supply finance, our UKEF guarantee, again, enables UK exporters to secure the import of critical minerals, all goods containing critical minerals to the UK. But this very much needs to be a tangible thing to have UKEF support. It can't just be facilitating cash flows of a trader, for example. The eligibility piece is quite an important one. So normally when we require the 20% UK content on other projects, this isn't the case here. What's needed is that the overseas buyer or borrower has an agreement, an offtake contract agreement with a UK exporter. So that's in lieu of the 20% UK content needed. Secondly, and very importantly, it needs to be on the governmental critical minerals list. I do believe, I think it was on the 28th of November, an updated list has come out, as I'm sure you're all aware, which has a larger scope and has it's a bigger list now than it was previously. So again, gives larger scope for support package from UKEF. And then finally, we obviously as a governmental entity have lots of due diligence that we need to look into. So in these cases, we'd be talking about the overseas buyer or even the exporter, passing anti-bribery, anti-corruption due diligence, and then ESHR, which is the environmental, social, human as well. And so on the actual scale and tenor of the product itself, so UKEF is able to guarantee a maximum of up to twice of the offtake contract with the UK exporter. And we actually can provide a bit more of this if there is more UK content provided in the actual deal, and we'll provide 100% level of that guarantee. We've got two options on the actual tenor. So the post-credit period, it would either be the shorter of twice the minimum length of the delivery period of the offtake agreement, or it can be in line with OECD arrangements. And for this, it can be maximum of 22 years repayment, which is obviously quite a substantial amount of time. So I think it's quite an exciting product. It is, as we said, it's hot off the press, a week or two old maximum. But it should hopefully help the UK anyway, be able to offer a substantial and significant source of critical minerals provided, and also able, obviously to offer financial support to the overseas buyer borrower in these cases, and all in line with governmental policy objectives of not having being too dependent essentially on the input, the source of critical minerals into the UK.
Yeah, I mean, we're seeing a lot in terms of the critical minerals, and that's where a lot of the activity is, alongside gold, obviously, given where gold prices are. But I think attracting finance is not always as easy as you might think from the outside for those sorts of projects, notwithstanding the need for security of supply in the UK. So I think it's sort of quite an interesting project. We've heard quite a bit here about sort of diligence and what the various sort of lenders require and the diligence they do on the project, environmental, social. I mean, Artem, can you say anything about what it's like to be on the receiving end of those sort of diligence requests and requirements?
It's normal. In my definition of a good transaction, social license to operate, to which many here on the panel have spoken to, it's included. We would not have bought Gediktepe mine in Western Turkey if the previous owner, Lydia Mining, who is now also a key shareholder, has not done an excellent job with the local communities, and if the excellent management that we have acquired together with the mine would not be investing heavily in all things ESG. So it is not a differentiator, it is one of those must-haves. You will not buy a mine anywhere in the world if it will not satisfy those criteria. Might not necessarily be upfront, but if we can bring it up to the global standards, that is okay. If we can't, that is a no-go. And this is certainly a critical piece of due diligence you have to do upfront, together with technical diligence. Our colleagues here in the London Stock Exchange are very thorough in terms of the mining companies coming to list in London. So we had to produce a competent person report, which goes into the very minuscule detail of the mining operation itself, and that's what we will have to do. It is what it is. So it's not unusual for a mining company in UK London Stock Exchange to produce competent person report, or in Canada 43101, which is essentially the same story. So diligence, environmental, technical, social is a key part of any acquisition, but you want to do it quickly and early to determine whether there is any legal issues, for example, in a particular license that you want to buy, whether there's any technical issues. Once those things are clear, then you can move on with your financing.
And it sounds like actually you wouldn't invest in a project that doesn't either have that good governance or that you can't apply that good governance to.
That's correct.
So it's not something that you put in place for funding. It is just part of what you do, and you hope to attract funding through having those standards and best
We are
practices.
a UK publicly listed company on the main board of the London Stock Exchange. We have independent board. And for me personally, as the chairman of this company, it's extremely.
And then Natalia, I think sort of we've talked a lot about sort of the big projects, but I know there's going to be a session which talks to it a bit more later today. But could you just say a word or two around the sort of the JUMP program?
Yes, thank you. We've been financing small companies and early stage exploration companies for a number of years on an ad hoc basis, but realized that a more systemic approach is necessary, and also realized that, you know, it's the beginning of the value chain. So it's very important to support those companies because they, as we all know, the process of bringing a mine on stream, or before even actually you start construction, takes about maybe on average 15 years, sometimes a bit less, sometimes a bit more. So we put together this structured 150 million euro program to help companies in our countries of operation with further development of those projects. And just to give an example of one opportunity that we supported in the region, in Kazakhstan in particular, I would like to mention Saratogan Graphite. It's a company that is developing a graphite project in central Kazakhstan in Karaganda region, which should be one of the largest in the world and has also very high grade. So we've invested 5 million Australian dollars. It's a listed company, listed in Australia, to help them advance studies and to provide working capital. Well, graphite is an excited mineral. It's essential for it's considered as a critical raw material in many jurisdictions, in particular European Union. So we're quite keen to support this company. As with all companies, in particular with the smaller ones, early stage ones, the key for us is the management team, because they could be an interesting asset. It could even sit quite attractively on the cost curve and have the potential, but this is the people who are developing it. This is that small management team that we will be relying on to advance the project and to bring it forward. So that's the key challenge, that's the key risk. Who is in the management team, whether it's a complete team, how people interact among each other, whether they have a solid track record of developing projects and bringing in to the next phase of the development, whether they're successful in raising financing for that, and why we decided to support it, and that's actually the essence of what we're doing in this JUMP program, because we felt that it's a very promising sector in a promising but undeveloped junior mining sector in Kazakhstan. And it is, if this project is successful, the junior mining sector in the country will become more visible and become more maybe attractive for external providers of investment and financing. We also wanted to support maybe a non-Chinese producer, because graphite sector in production, but particularly in processing, is dominated by one country, and we would like also to contribute to the diversification of supply chains. It's also a private sector project, which we felt was also important to support because it has a potential to bring best industry standards into the country, both in the ESG sense and also technology sense. And as I said, we also very much liked the project team. But of course, you know, with all early stage projects, there are a lot of challenges, and we don't know whether it will make it to FID and whether our investment will be successful. But we felt that for this stage, the key ingredients for success were there. And then we will have to wait and observe. We are prepared. You know, when we support junior mining companies, we're also prepared not only to do it with a little one-off investment, but also plan to be there for next fundraising stages and eventually for construction finance as well. So it's a partnership and it's a long-term journey, which we hope at least for some of our investee companies would be successful.
Great, thanks. We'll open it up to the floor just for one question as we're sort of trying to make sure that we don't sort of overrun too much despite the sort of slightly later start. Has anyone got any question they want to ask any of the panel? There you are.
Yeah, my name is EBRD. I'm a geologist with the British Geological Survey. Just had a question to the
Speak to the microphone, please.
Hi, hopefully you can hear me. My name is Emer Didi. I'm a geologist at the British Geological Survey. The panel has been really interesting and very insightful. Thank you. There's been a lot of mention of funding of mining operations or exploration companies, but what I'm not really hearing is a lot of investment in the processing side, because you've kind of made the point that, and we've seen in previous presentations, that China really controls the market and all of that. And really, how are you diversifying supply if really the flow of materials will end up getting processed in China?
Who wants to take that? Well, we'll hear from Martin first, and then Martin.
I can start. In my view, mining and processing are two different industries. So you have to have a processing people here on the panel to ask about that. The margins are different. The competitive game is different. The entry barriers are different. And the key to success is different. In processing, that's customer relationship. In mining, that's low cost, which is a very different set of skills. So I've been in the past have pushed a big aluminium company, Rusal, to sell off its downstream assets because I didn't believe, as a head of strategy of that company, that those should belong into the same company. Investors can choose where to invest in mining or in processing, but those are two different industries, if you ask a mining person.
Martin?
Yeah, I mean, I gave the example of Mongolia, but as a development institution, this is something we're really looking at. It's not easy because the barriers are very high, and especially in the emerging markets. Much of the processing, you need energy, you need water, you need human skill set. So one of the things that we're doing with the World Bank Group and private partners, as well as the G7, is a program called RISE, which means basically resilience in supply chain, and looking to see where should we be thinking about, because every country cannot have a processing facility. So one needs to think about synergies, and for example, in Africa, regional coordination, regional synergy infrastructure is a big issue. So within that program, the idea will be to build early stage leads and then put them up as potential projects they come up in terms of regional coordination and clusters, because you really can't have a smelter every 10 miles in DRC, right? Or 2 alumina refineries in Guinea, for example. So, but we are working also on the private side with the private clients to see how we can even try to bring concessional financing. And as I see our EBRD, we tend not to do concessional financing in USD generating projects, but there are other places we can do that.
Great.
And 15 seconds from me, I'd say the demand is there on public institutions would happily support a good quality company, especially if it's also competition provides an alternative in global competition. I think it's the supply issue, so it would be great to see more companies like this coming to market.
Great. Well, Natalia, for your last remark, and then we're going to have to close the session.
I just tend to agree with Namrata, because from, again, developmental perspective, we totally sympathize and support the countries to develop downstream value chain in the countries, because they don't want to simply sell, cheap ore. They want to develop skills, develop SME industry around the mines, develop processing. And we can see it in Uzbekistan with Al-Malik as well, but Al-Malik is large established company, and they're already halfway on this pathway, but also in Western Balkans, in Serbia. We all know the debate that has been happening in the country around Yadar project, and whether it should be purely extraction of ore, or should be EV value chain in the country being built.
Great. Excellent. Well, I would just like to thank Iona, Artem, Namrata, Chris and Natalia for their insights. I think it was really good to hear. Oh, sorry. From my perspective, I think it's really good to hear actually practical examples, the challenges they face, the importance of political risk, ESG. But I think Artem's opening remarks are the very most fitting closing remarks as well, in that a good project, well run, will always get finance. Thanks very much.